This video will work through problem 4.4 of Gapenski's Healthcare Finance, 6th edition. And to make this easier, I'm going to go ahead and switch the view here to Excel. We're not actually going to use Excel for anything other than just to allow me to write it a little more neatly than I would with my sloppy handwriting. Okay, so in 4.4, we are presented with a list of accounts and their balances in alphabetical order, and we're asked to create Warren Clinic's balance sheet. So basically, we've got this jumble, and we've got to sort it out into the appropriate balance sheet format. Okay, so remember the balance sheet, there are two halves to the balance sheet. And I'm going to do a left-right rather than a vertical, but it really works the same. So the left side of the balance sheet is the assets, and the right side of the balance sheet is liabilities and, let's see, equity. I'm just looking to see whether they were listing this as a not-for-profit and using net assets, or whether they were using equity. And I usually like to say owner's equity, but that's neither here nor there. I'll make this just a bit smaller. Okay, so we've basically got to figure out two places where, two sides, first of all, where these things go. So in order to do this, we have to understand what each of these things is. So accounts payable. All right, so briefly, accounts payable is IOUs that Warren Clinic, Yeah, Warren Clinic has to other organizations. And these are short-term, like an IOU, like, hey, I'm going to pay you next week. Can I borrow $5 today so I can buy a half-calf decaf latte, at Dunk, and I'll pay you back next week when I get my, pay. So that would be an account payable that you would owe your friend $5. Well, in this case, Warren Clinic has $20,000 in short-term obligations that it owes to someone else. Those are liabilities. And so we're going to put those over here. I'm going to make this a little wider. There we go. So these are accounts payable is an example of current liabilities, meaning short-term, current meaning it's going to be expected to be paid off in less than 1 year. Okay, next down, accounts receivable net. Okay, accounts receivable is Warren Clinic operates on accrual basis accounting. So when one of their providers sees a patient, let's say the patient's bill is $100. Chances are they have a copay, so they would pay Warren Clinic $20 on the day of the visit, and then let's say that clinic visit is $100 total cost. Warren Clinic would then bill out $80 to the insurance company. Until the insurance company pays Warren Clinic carries that obligation to Warren Clinic as what's called an accounts receivable. So this is a thing we think we're going to get. So we're going to put it over here under assets. And I'm going to slot it down one because I know I'm going to put something else above it later. So accounts receivable for Warren Clinic is $60,000, and that is a current asset as opposed to a current liability, right? And it's a current asset because it's expected to be converted into cash or used up within a year. All right, what's our next thing? Cash. Well, cash is a classic asset, right? If you can, so my rule on assets is if you can spend it, touch it, or sell it, it's an asset. And so those are, so that's kind of a good rule of thumb when you think about, like, when you're running down this list, is this something I can spend? Is it something I could sell? Or is it something that I could touch? Then it's probably belongs in this side of the balance sheet, in this column, rather than over here on this side. Okay, so next is equity. Well, equity, belongs in the liabilities and equity portion, and it represents the owner's equity, the portion of the organization that is, or the portion of the assets that the owners have the rights to. And so they have the rights to $230,000 of the total assets. The rest will belong to the people who have other kinds of obligations from the organization. So we'll get to there in a minute. All right, what's next? Long-term debt. Well, long-term debt is something you have to pay back, right? So it is a liability. So we're going to slot that over here. Long-term investments. So not-for-profit hospitals and other large organizations, for-profit and not-for-profit, may have long-term investments where they take money, set it aside with the intent of using it somewhere down the line. So, for example, a hospital may be setting aside money in order to at least partially fund the building of a new hospital building, perhaps, or a new wing. So that is an example of an asset. Can you touch it, spend it, or sell it? Well, you could sell long-term assets. So they belong over here. Sorry, long-term investments, and they belong over here. Net PPE. So your book actually lists it as net property and equipment. I'm calling it net property, plant, and equipment. That's my shorthand. So property, plant, and equipment refers to the stuff, the physical stuff that the organization has. So this would be your buildings, your vehicles, all your equipment, anything that is going to last more than a year, right? Because if it's not going to last more than a year, then it's probably inventory and you would just expense it. But net property, plant, and equipment is stuff that has some sort of long life that we're going to depreciate. So I'm going to put that over here with the long-term investments. Then I have other assets not defined, and so it could be a variety of things, but it's telling us it's assets, and so I'm going to put those here. And then finally, other long-term liabilities. I'm going to slot over here, and I'm going to make a little more room. Okay, and that's it. So we've now distributed all of the entries, and we need to do a little more bookkeeping to neaten this up. So the first thing we want to do is write in a subtotal for current assets. And so we're going to write current assets, and then we'll subtotal this portion. So sum 30 plus 60, right? So that's just 90,000. So easy math here. Neaten this up just a bit by bringing it up. Okay. So we have current assets. This is our total current assets. We treat them differently than long-term assets because current assets tell us this is the amount of assets that we have that are easily liquidated, turned into cash, that we could use to meet the obligations, the current liabilities of the organization. And so it's important to put them, separate them, and identify them on their own. Now, one point is when you're doing your list of current assets, you want to go from most liquid, meaning most cash-like, to least liquid. And so what's more like cash than cash? Well, you can't really be any more like cash than cash. So cash goes at the top. And then going down the list, you kind of want to follow a logic of which is most cash-like. Well, accounts receivable, it can be sold. There's a process of financing against accounts receivable, or you can sell them. It's called a process called factoring, which we're not going to get into. But the point here is you want to list things in the current assets section relative to how easy is it to convert these things into cash. Okay. Then down here, this other portion of the asset column are the long-term assets, things that are going to be hanging around the organization for a year or more, right? And so that's these three things here. And then we're just going to create a summation for the column for total assets. And we're going to say that's equal, we're just going to add up the long-term assets plus the total of the current assets and gives us 380,000. Now over here on the liabilities and equity side, we have current liabilities just like we have current assets. And in this case, this is a relatively simple, um, uh, uh, simplified balance sheet. So there's only one current liability, and in this case, it is the accounts payable. So that's simply going to be, we still want to have a total there. Um, and center this a bit. We still want to have a total there just for good form, okay? And then because in most problems you're going to do, other than this one, you're going to have multiple entries for accounts payable. And then you have other kinds of long-term liabilities. So you have long-term debt. That might be a mortgage or a bond issue. And then other long-term liabilities. So we're going to total up our total liabilities. That's going to be the long-term liabilities plus the current liabilities, gives us total liabilities. Then we have equity, and then we have, and we don't have to really do anything with that. And we can say total liabilities and equity now. And that is the sum of the equity plus the total liabilities. And notice that my total assets equal my total liabilities. So if you're working through a balance sheet problem and you get to the end of it and you're like, oh, the total assets don't equal the total liabilities and equity, that's a good indication that you've done something wrong. So you always want to make sure that the balance sheet balances, right, left and right. Now, you could have, and it wouldn't be wrong, you could have just put this one under the other like this, and that would be perfectly acceptable as well. I just kind of like doing it side by side when I can, because the idea of a balance sheet is you have a left and a right, right, and the left must equal the right. It's a little more visually useful for teaching purposes, but very often when you actually see a financial statement, it will be laid out in a column format with assets followed by liabilities and owner's equity. Okay, so that is it for 4.4.